how you doing? Welcome back to another video on DOY side, your favorite trader, favorite creator. As you see, we are on the fourth video, which is the second to last video for this series. This is the basic series. The next series that comes out is going to be going over the strategy and a lot more stuff. Strategy, we're going to be showing some live trades from the community and whatnot. We're going to be getting a lot of videos out, and I'm probably going to drop them all at once. So I might give like a scheduled date of when I'm going to drop them, because I want it to be like a full 30 day, you know, from week, start of the week to end of the week. And then boom, throughout the whole month. So it might be 30 days, however many trading days are in the month, regardless, right? But today we are going over inefficiencies, but our favorite way to say it, fair value gaps. Fair value gaps, inverse fair value gaps, however you want to say it. This is a concept or confluence, I wouldn't say created. Well, really, yeah, it is really created by ICT. Okay, so I'm assuming it's the grid lines that's making it look like that. Let's take the grid lines off, or make them a different color, just so y'all can see everything. The background, we'll make it solid, probably white. You'll never take me to bang. Right, I jumped stuck in my head. Grid lines, this is the problem, yeah. So let's make the grid lines, we'll make the grid lines all the way white. I just want y'all to be able to see these wicks. I don't know. Maybe we'll change the color of it so it'll come out a lot easier. Then that kind of looks iffy. I don't know if it's showing up on the YouTube like that. I don't like the way that looks. But yeah, we'll just make the fake wicks white. At least they pop up. Boom. So while we're doing this, we're gonna go over inefficiencies. It's basically the area of the market. I told you the market actually is a line. That's how old school is, everything. That's how it was from the beginning. The market is basically this. It's basically a line moving, getting in certain areas and stuff like that, right? So it's a line moving. When we put it into candlesticks, it allows us to be able to read the market a lot better. And what we see with this, I'm trying to get the perfect area so y'all can see all three of them. Boom, you just know it's wicks right here, alright? So what we see with candlesticks is just basically breaking it down a little bit more so you can be able to read price action and kind of anticipate where it wants to go and take trades based off that, right? So with inefficiencies, this happens with candlesticks whenever we get a violent move out of an area. So technically we like to leave an area that's untested. So I'm gonna mark this out right here. The way that everyone loves to say it, it's the same thing. If they said inefficiencies or fair value gaps, that's basically what a fair value gap is. It's an inefficiency. So a fair value gap, first thing first, it has to be a 3 candle pattern. Alright, if this was just this one candle and then this one candle flew all the way up here where the next candle came down and took it out, it's not a fair value gap. It has to be a 3 candle pattern, right? And the fair value gap or the inefficiency is the area that was untested. So we broke out so quick, meaning if you know how candle closures, open and closures work, which you should know, the full basics, right? So basically, since this is a bullish candle, it's green, a buy candle, we opened down here. This was the lowest we went to with the wicks, and we closed here. This was the highest we went to. This candle is a lot more like equal, I would say. We opened here, because it's a bullish candle. That means we close higher. We open here, we closed here. This was the highest we went, this was the lowest we went, right? This area in the middle, where these two candle wicks never touch, this is marked out as an inefficiency. So it's technically like what I like to say, what I don't hear a lot of people say, but what works for me, it's a draw in liquidity. If we're being honest, it's a draw in liquidity. So y'all can see the wicks at least. Alright, boom. So it's just another draw in liquidity, right? So what the market tends to do with these areas is, say we leave this fair value gap, we come up here and make a few market structure, and then we come down and we tap into this. We may use this to continue to run higher from here, right? So we feel these inefficiencies to continue. What another one is an inverse fair value gap. So let me show you guys that. Let's make this, we're gonna make this a red candle, right? So boom, boom. Alright, so the candle open, let's say the candle open here, we'll put a little wick. Alright, so yeah, so the candle opened here from this one. So the candle opened here, we see this wick came up, tried to take out this high, it failed to, right? But this is my favorite thing, because when you join the chat or whatever and you learn to trade with me, you're gonna see me talk about this a lot, or you're gonna see me use this in my strategy a lot, because I just love the way that they work. It's a confluence that worked for me. That wick is off, but who cares? We'll just move like this. Okay, so this is an inverse fair value gap, right? Let's put the third candle, because remember, fair value gaps have to be a three candle pattern, right? So boom, here's an inverse fair value gap. Basically, it's the same thing as a fair value gap. It's just reversed, right? So we have a fair value gap here. We broke out of this area with strong price, right? We left an area we didn't touch, we didn't wick into it, and we continue higher, right? So inverse fair value gap, most likely, they happen a lot, but the more significant ones, it's when we perform a liquidity sweep. When I showed you in the liquidity area, so say this was a high right here, a 1 hour high, 15-minute high, whatever, just a significant area to take out, and we come take this out, and then we inverse this fair value gap. So now, that's why you see me have this here. You'll see me do it all the time. Whenever I'm actually trading, I'll mark out a fair value gap. So this area now, this area was inverse. We basically flipped their fair value gap was here. So we broke out of this range with strength, and we took it back over with a lot of strength, and then we left this inverse fair value gap, right? So inverse fair value gaps, the same thing is going to happen. It's going to eventually get filled, but a lot of people, including myself, this is a confluence that you can use to take you a certain type of trade, whether you're looking for a retest, rebalance, or a full a full reverse and continuation trade, right? So what happens with the inverse fair value gap is what I said, we're gonna retake that area, but it's basically a confluence to let us know that the manipulation is over, and manipulation happens before the big move happens. If you know what you're doing when you're trading for a while, you realize that the manipulation happens before the big move happens. So let's see if y'all can find the inverse fair value gap. I'm gonna give y'all about 10 seconds. 10, 9, the main inverse fair value gap. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Okay, boom. So let's read what's going on here. We have an area of weakness. You see we start consolidating down here. We didn't break out of this area to go up, and we want to take out these highs. This high is from Asia session, right? Asia session high is too strong. So what happens? We fell, we get weak right here. But then what did we create? What did I say? First thing we did after we broke out of this weak area when we failed to try to sell off, we created a fair value gap. But what happened afterwards would have given you an entry to take this trade. This is a perfect example of an inverse value gap right here. So boom, you see we broke out of here. You see our three candle pattern. You see this area that we left, that body of it, which was fair value gap at first. But we created this doji candle, came down, flipped the candle, and then we got our three candle pattern right here, and you see what happens. The manipulation happened. ES probably took out this high and created SMT, and Q didn't. And then you see what happened. We sold down off here. We came back to tap into that inverse fair value gap because this high is that strong and we didn't take it out the first time. Some traders, some may be skeptical and be like, okay, now we're definitely going to take out the high, but some traders may have taken this and be like, okay, this is my entry. I understand that this high is significant and we haven't taken it out. We've had countless times to do it. Right here, we failed. We could have came up, took it here. We failed to even take out this one. Could have came up here and took it. We failed. We sold off. We didn't have enough seller strength, so we came all the way back up to what? Again, touched another area of resistance. Failed again, created an inverse fair value gap. I'm taking this trade. You could have taken this trade to just take out these lows, to come take out maybe this wick low, just for 1 to 4. But what did I say? The manipulation happens before the big move. So what was the manipulation? Here, this leg up. We trapped buyers here, and we continued to sell off once we failed to take out this high and created an inverse fair value gap. And then as we're going down, you see what we're creating. We have fair value gap here. That's a fair value gap. We have you never take me to. So this was technically a fair value gap. I don't like that one because we have this bullish candle trying to engulf this right here. But then we also have another inverse fair value gap, which is here. So now that we're taking out these lows, some may work a little more or stronger than other ones. Some may not work as strong. But you can see we took out these lows down here, which is this low, wicked it out, failed to create any market structure, so we came down to take it out again, and now this is our inverse fair value gap. And same thing, people may enter this trade here, stops below or near the recent low, and since they have such a huge stop, if I was the one trading this, I would be looking for something small like 1-5. But as you can see, this is a perfect area to target because of what's above here, a fair value gap. And like what I said earlier, they are basically little small draws on liquidity. So you could enter that, boom. You see how we came down, we had that fair value gap, it's a draw on liquidity. So basically this is not, I don't want you to just take every inverse fair value gap. That's why I said some traders may have took its entry to try to come take out this high now. I wouldn't take that immediately because what did I say right here? But in case someone did, you see this was an inverse fair value gap. It was a draw on liquidity. We turned around to take that out, right? We turn back around, we take out that low. But as price moves, price will create these gaps. Now, right now, we're on the 3-minute time frame. The higher the time frame you go to, the more significant the fair value gap is. Why? Because the higher time frame, no dips every other time frame, because this is the real market structure. Basically, like what did I say, time frames is like a magnifier glass. You're just zooming in to be able to see price more clearer, right? So what do we have here? We have fair value gap here, fair value gap here, fair value gap here, right? All of these gaps are significant. So even though price might be making higher highs and doing its thing right now, eventually, because what did I say, a stock or price cannot just continuously go up. It has to come down, take out liquidity, turn into a downtrend, fail to continue the downtrend, break up, do uptrend, may consolidate, but it can never stay in one motion. That's just not how it works, right? So these gaps are draws in liquidity, and ICT has a better way of explaining them and everything. I use them, but I don't use them entirely too much anymore. They were like my bread and butter when I was trading. When I first, dang, my fault, Fiona. When I first started trading, they were my bread and butter. But as I got better at reading price action, I just kind of used them more as like a confluence and not my favorite type of entries and stuff. And now I read price exactly from what it's doing, and then that's how I enter. But that is fair value gaps. They are very strong, depending on exactly where your fair value gap is. Like I said here, if this was a full liquidity sweep, it would be stronger. Instead, it still is strong because, like I said, ES may have taken out this high, created SMT, but you can see that this high is significant and this area is significant. So an inverse fair value gap in a significant area is a significant entry, significant reason for price to move and stuff like that, right? So you'll see these everywhere. There's fair value gap entries, inverse fair value gap entries, whatever. Like, boom, somebody on the 3-minute time frame marked out this one. Say this fair value gap looks strong. I want to take me, a quick trade out of it. They enter at the midpoint. Maybe stops below here at the doji, and boom, look, they caught them an easy 1 to 2 right there. So they're gonna be small base hits all the time with these fair value gaps, and they're gonna be huge moves where these fair value gaps present themselves. So what I advise you do is that you use them to your advantage. Use them as a confluence. Don't make them your bread and butter for everything, because then you'll end up in a position where you're taking every single fair value gap and every single one is not significant. How do you determine their significance? Use your higher time frame. So we tap into, let's say maybe price was down here. We tap into a 15-minute fair value gap, and then you drop down to the 5-minute, and you see us create some weakness in structure, and then you see a 3-minute or 1-minute inverse fair value gap to come back out of that, because like I said, we can either come down and where the freak is it? We can either come down, so say we going up, we left that area, we can either come down and tap into it to bounce off, or we're gonna come down to sweep it out, which is another reason why you can clearly see that there are just many liquidity pools. There are many areas of liquidity, because what did I say about liquidities, highs and lows? What do we usually do at them? We're gonna come down, we're gonna sweep it and fully reverse, or we're gonna sweep it and then continue running, right? So they're just small areas of liquidity. But yeah, that's the end of this video. We have one more video coming out for you guys. It might come out tonight. Let me see. Yeah, because I got a session to handle in a bit. But we have one more coming out, which is just volume. It's just news and volume. I think I'm going to show you guys CPI, because certain news days you want to stay away from, or you want to go in being very cautious. So yeah, I'm probably going to show you guys a CPI day, because those are usually crazy and you want to be aware of those, right? But that is inefficiencies / fair value gaps, inverse fair value gaps. We're going to have other confluences under strategies and everything that comes out, but just do your homework, use that, show me you can identify them. If you choose to put this into your trading style, or you already do use them in your trading style, just show me how you use them, and always feel free to ask questions, or maybe ask me why one didn't work or something like that. I'm always down to give answers or whatever you guys need. But you guys have a great day. Look out for that last video, and we also have a series coming out of our daily trades. So as always, stay DOY, pray, read your Bible, and understand Jesus loves you.